Welcome to Iron Financial. Today, we are forging a deep analysis of a company you think you know, but whose stock is telling a completely different story. We're talking about Build-A-Bear Workshop, ticker BBW. Now, this isn't about childhood memories, all right? This is about hard numbers and a corporate structure that's either built to last or, well, ready to crumble. Our job is to stress test it, see if it holds up, and figure out if it belongs in your portfolio.
Right, and that gets us to the big question right out of the gate. Look, the market is supposed to punish misses. It's one of the most basic rules of the game, right? You fall short of what the analysts expect, your stock takes a hit. Simple. But on March 12th, Build-A-Bear reported their fourth quarter results, and they fell short. They missed. Yet the stock did something completely illogical, something that should make any serious investor stop and ask, what on earth is really going on here?
It rocketed up, over 23% in pre-market trading. Let me just say that again so it sinks in. After missing expectations, it jumped by nearly a quarter of its entire value. That's not a small crack in logic, that's an earthquake. The market looked straight through a disappointing holiday quarter and saw something else entirely. So the question for your portfolio is simple. Is this a sign of deeply rooted strength, a fortress the market just finally recognized, or is this a very well-built trap designed to lure in unsuspecting money? Okay, so here's how we're going to hammer this thing out today. First, we're going to build the bull case. We'll dig into the load-bearing numbers that convince the market to look past 1 weak quarter. Then, our skeptic here is going to grab his hammer and start looking for the structural flaws. You know, the cracks in the facade. After that, we're going to stress test the leadership transition, because that is a major variable here. And finally, we will forge our verdict. All right, let's fire up the forge and get to work.
So let's start with the bedrock. Investors didn't just react to 1 weak quarter. That's the key. They reacted to the fortress this company has been building for the last half a decade. You just don't get a 23% pop on a whim. The market saw something much, much bigger. They saw a long-term strategic construction project that is paying off in a massive way. And you know what? They chose to reward the 5-year blueprint, not punish the 3-month result.
And this quote from the CEO really says it all. This is the 5th consecutive year of record results. Just let that sink in. 5 straight years. This isn't just a good year. It's a dynasty of them. This isn't some little comeback story. This is a story of sustained, powerful construction. While other retailers were literally crumbling during the pandemic and its aftermath, Build-A-Bear was laying steel beam after steel beam.
And here's the first big number. For their most recently completed fiscal year, revenue hit nearly $530 million. Now, that's up a solid 6.7% year over year, which is respectable growth for any retailer. But the key figure here is that $500 million mark. For the first time ever, they've breached it. This company is a heavy-duty operation now. It's a significant player that has graduated from just being a niche mall store to a diversified global brand. That $500 million number, that's a huge psychological and financial milestone that the market simply could not ignore.
And here's the proof that this growth is quality growth. A record diluted earnings per share of $3.99. See, this isn't just revenue growth that's been fueled by burning cash on marketing or endless promotions. No, this is profitable growth. The machine is efficient. Every single dollar of revenue is contributing more and more to the bottom line year after year. That right there is the hallmark of a well-managed, robust business model that puts shareholder returns first.
And this number, this just brilliantly illustrates the point. A return on equity of nearly 40%. Let me put that in context for you. In the retail space, anything over 15 or 20% is considered excellent. 40% is absolutely stellar. It's an incredible number, and it shows just how effectively management generates profit from every single dollar of shareholder money that's invested in the company. They are not just building a bigger company, they are building a more profitable one. It's a capital-efficient fortress.
Now, what's really interesting about this slide is the long-term view. This is the blueprint of the entire turnaround. Just look at the sheer power of the transformation between these 2 points in time. Revenue? Yeah, it's up a respectable 47%, which is solid growth. But look at EBITDA. That's earnings before interest, taxes, depreciation, and amortization. This number gives us a pure look at the core profitability of their operations, stripping out all the accounting and financing stuff. And that number is up a staggering 430%. They have fundamentally re-engineered the profitability of this entire business, expanding their EBITDA margin from a flimsy 4.5% to a rock-solid 16.3%. That's not just growth, that is a complete operational transformation. So how'd they do it? Diversification. That's how.
This is not your childhood mall store anymore. They are expanding their footprint intelligently. They're going where the customers actually are. Airports, tourist hubs, even cruise ships. They've got wholesale deals with giants like Walmart, putting their product in 1,500 different locations. And critically, they're targeting the kidult market. Their own data shows that 40% of sales now go to teens and adults. They're building out, not just up, creating multiple, resilient revenue streams that are way less dependent on that dying traditional mall traffic.
All right, that's a nice, polished story. A solid foundation, a fortress. Okay, let's take a sledgehammer to it and see what cracks. It sounds great when you only look at the 5-year highlight reel. Of course it does. But you can't just ignore the actual report that started this entire conversation. The market may have had a moment of irrational exuberance, but we are here to inject a heavy dose of reality. The market might have looked past this, but we are not going to. Let's put the full-year record right next to the Q4 reality. The fourth quarter, their critical holiday season, missed revenue expectations, and it missed earnings per share by 2 cents. A miss is a miss, period. But the real alarm bell here is that pre-tax income. As you can see, it fell from $27.5 million in the prior year all the way down to $21.5 million. That is a huge drop in profitability during their most important sales period. Momentum is slowing down, and that is a major red flag that the good times might just be rolling to a stop. And look at the digital foundation. It's eroding. Consolidated e-commerce demand was down over 13% in the fourth quarter. For the full year, it was down 5.5%. Look, in today's economy, if your online presence is shrinking, you are going backward. It's that simple. The bull case talks about all this diversification, but their primary digital channel, the one that's supposed to represent the future, is showing significant weakness. That's a serious crack in any modern retail fortress. So the crucial point is, why is income down? And why is the company's own guidance for next year so cautious? They're projecting anything from a decline to low single-digit growth. It's not just inflation or some vague macroeconomic conditions. No, there is a specific, quantifiable, and growing problem that they had to swallow last year. A problem that is only getting bigger. That's the impact of tariffs and related costs in fiscal 2025. This isn't some projection I'm making up. This is a fact, right from their earnings report. $11 million. That is a direct hit to the bottom line that essentially wiped out their pre-tax income growth for the entire year. Without this, their record pre-tax income would have looked a whole lot more impressive. This is a powerful headwind that is already hitting them hard, eating directly into their profits. And the pressure is building. The company is explicitly guiding for a $16 million impact in fiscal 2026. That's a 45% increase in pressure on their profits. This isn't just a crack. This feels like a planned demolition of their bottom line. Their entire pre-tax income guidance for next year hinges on this one number. They are telling you loud and clear, the storm is getting worse, not better. This external force is hammering their profitability, and it's a huge problem that is not going away. Okay, that is a powerful headwind. And that $16 million number is something no investor can ignore. You're right. But a storm is also the ultimate test of a structure and of the architects who lead the crew. The strength of a company isn't just about weathering the current storm. It's about how it's built to handle the next one. And that comes down to leadership. And here, Build-A-Bear isn't panicking. They're executing a plan. You see, this isn't a sudden shakeup. This isn't a CEO being forced out after a bad quarter. This is the exact opposite. The company is executing a multi-year, board-driven succession plan. They are handing the keys from the architect of this entire 5-year turnaround, Sharon Price John, to the guy who was her right-hand man helping build it, the COO, Chris Hurt. This is a blueprint for stability, designed to ensure the strategy continues without a single hitch. It's a sign of a mature, well-run organization. And his incentives? They are welded directly to shareholder interests. Just look at his pay structure. A solid base salary, sure, but the real money is in performance. His annual bonus target is 100% of his salary, and a full 70% of his long-term incentive pay is tied directly to performance metrics. He only wins if the company's structure gets stronger and shareholder value increases. He's not just living in the fortress, he is being paid to expand its walls and defend it from those tariff headwinds. Okay, stability is one thing, but they're changing the general in the middle of a battle. The tariff storm is intensifying, not receding. So is an insider, no matter how prepared he is, really ready to handle these massive external threats that the previous, highly successful leadership already saw impacting profits? I mean, you can have the best blueprint in the world, but the timing of this change, right as the biggest financial headwind is accelerating, that's a huge risk.
The new CEO has to prove he can navigate this storm from day one. There is no grace period here. Okay, we've laid out the steel beams of the bull case, and we've pointed out the potential stress fractures from the bear case. We've examined the leadership structure. Now it's time to bring it all together, apply the heat, and deliver the iron financial verdict. So, we have a company with a proven, powerful economic engine redesigned over 5 years to be a profit machine. But that engine is heading directly into a significant $16 million headwind, with a brand new driver taking the wheel. So the crucial question is this: is the engine strong enough, and is the new driver skilled enough to power through it without stalling out?
Here it is. The market's 23% surge was an overreaction. It was an emotional response to the long-term story that completely ignored the immediate risks. But the underlying business is a fortress. The foundation is solid, built on years of smart diversification and a fundamental re-engineering of profitability. The tariff headwinds, however, are a serious and growing threat. They create a moat of uncertainty that you simply cannot dismiss. So this isn't a trap. The numbers are too strong for that. But it is not a simple buy either. This is an opportunity for investors who have the stomach for volatility and a firm belief that the structure management has built is strong enough to withstand the coming storm.
You've seen the blueprints, and you've seen the stress tests. The long-term strength is undeniable, but so are the short-term pressures. The company has laid one heck of a foundation, but now they have to prove they can build on it through a storm. Now you have to decide if you're ready to start building a position. That's all for this edition of Iron Financial. Do your own due diligence, forge your own path.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.